So we're doing, derivatives. We're doing future options. Right. So, this, let's summarize what we did last time, or should we move forward? So there's something which we missed out, which is basically, the trading cycle here. Can you read, Nikita?
3 month trading cycle, the near month 1, the next month 2, and the far month 3.
So basically, it has a 3 month cycle, as in the futures. That means the near month is not like February, it is getting expiring rates. We have the next month, which is closing on March 31st, expiring on March 31st, and then the April 27th, it happens to be the first day. Then read further. Huh? Why it is called? Very cycle means, at any given point of time, if you have to speculate or if you have to hedge your portfolio or whatever you do, if you go to the future and options market, you have to take a position. You can take position either in the month of February or March or April. So 3 months contracts are always valid. So February month is the last day is closing. So now we have March, April, and May. 3 months trading you can do any time. You can take a position any month of the day you want, any month. You can go long in the month of March or February, or April or May. Right? So the month which is the near month is called the month which is currently running is called the near month. Then mid month and the far month. Right? The May will be the far month. Was that your question? Or something else? Or something else?
Sir, the trading has 90 days from like this month from here on we have 90 days.
This is a cycle, okay? Like we have 3 months all the time open at any given point of time. This is the trade cycle. It's a cycle. You can't go beyond this. But of course, we have 1 month, 1 year contracts also available. They are only available to the institutions, okay, not for the normal people, okay. So, okay, read.
For Nifty 50 options, every Thursday of the week.
So, for stocks, it's 3 months. For Nifty, you have a weekly options in addition to the 3 month stocks. So they will close every week also. So you can take weekly positions also in Nifty 50.
Every stock has a Nifty option.
Yeah. So for Nifty 50, okay.
Yes, sir.
Yeah.
But every company also has a Nifty option.
Yeah, absolutely. Again, read further.
In case the Thursday is a trading holiday, the previous trading day shall be the expiry last day.
So last Thursday is considered to be the day on which the expiry happens. But if it happens to be a holiday, then it will be the previous trading day, which will be considered as the expiry day. Okay. Okay.
All contracts shall expire at the normal market closing time on the expiry date or such other time as decided by
So all contracts will get expired and they will need to be squared off on the expiry day. Okay. So we're talking about strike price. We talked about last time. So there are some more slides which we'll read. Nikita, can you read?
the strike price denotes the price at which the buyer of option has the right to purchase or sell the underlying.
Basically, the strike price is given by whom? It is given by the stock exchange. By stock exchange. Okay. So they give us the strike prices and we have to choose them. So we can take any position choosing the strike price on the underlying. Now, underlying can be any stock. Okay.
The strikes in options of most Indian shares are in multiples of rupees 5 and rupees 10. Generally speaking, 5 to 6 option prices are available on both sides of the current price of the
Of course, things have changed now. So you'll find multiple strike prices which are available now. Okay. So earlier they used to have 5 or 6 strike prices with a range of between 5 and 10, separating them. But today we have multiple kinds of strike prices.
For example, the Tata Steel stock trading at rupees 1300 might have options listed with strike of rupees 1270, 1280, 1290, 1300, 1310, 1320, 1330.
So basically, you have to choose the strike price, okay, yourself. And your choice will depend on how much premium you want to pay, how much bullish you are, or how much bearish you are. Okay. If you are mildly bullish, you are extremely bullish. Okay. And all of those factors will lead to which kind of strike price you will actually then done that. Okay. This is the first message. So these will be the various strike prices which you have to choose. Okay. For example, if the stock is today at 1300, okay, and if you choose 1280 as a strike price, will it be in the money, out of the money? In the money, and it will carry a higher premium. and 1340 puru out of the money, because your profit will start after 1340, isn't it? So first the stock has to cross 40 rupees, and then it will start making money for you. So the premium will be the least here. Okay, if these are the strike prices. Okay, and 1300 will be called what? At the money or close to the money. Okay, fine. Of at the money. No, it will be it will be a range where out the money will be the least. In the money, as we go deep in the money, it will become costlier, and at the money will be the normal. It will be somewhere in between. Okay, and we'll understand how they are priced. Okay, fine. It will depend upon its volatility of the stock, how much time is there. Okay, a lot of factors. There are 4 or 5 factors which we'll be doing today. Huh? Yeah, yeah. Today we'll be going to the, I have just given a link to you on the WhatsApp. So we'll just visit that and understand, how the premium can change. Okay. Okay, read.
The strike price is also called exercise price.
So this price is, some people call it strike price, some people call it exercise price. Okay.
This price is fixed by the exchange for the entire duration of the option, depending on the movement of the underlying stock or index in the cash market.
Okay. Fine. This has actually been provided by the stock exchange, the strike price. So in the money,
Call option is said to be in the money if the strike price is less than the market price of the underlying stock. A put option is in the money when the strike price is greater than the market price.
fine. Is it okay? अगर in the money call option कब होगा? When the strike price is less than the market price. Okay, fine, and it will be just the reverse if it's a put option.
For example, if the Tata Steel stock is trading at rupees 1300, the Tata Steel call option with strike 1290, 1280, 1270 and below are all in the money. For example, if the Tata Steel stock is trading at rupees 1300, the Tata Steel put option with strike 1310, 1320 and above are all in the money.
All in the money, because if you take a bet on 1320, so your profit will start at 1320. Already it's 1300, so you're sitting on a 20 rupees a value which is called intrinsic value. Okay, so the word will be used. So the difference between the price intrinsic, the value which is already in the money, and between the price of the stock price, that is called the intrinsic value. Okay, so you're already sitting on a profit of 20, but of course the option premium will be so high that you will not be able to make money even if it stops there, because it has to, the premium will be higher. Okay, in that case.
A call option whose strike price is above the current price of the underlying stock is out of the money, or a put with a strike below the current price is out of the money. When Tata Steel is trading at rupees 1300, the Tata Steel call option with strike 1310, 1320, 1330 and upwards are out of the money. When Tata Steel is trading at rupees 1300, the Tata Steel put option with strikes 1290, 1280 and downwards are out of the money.
Is that okay?
Yes.
So, actually it was so difficult in times when, we are not seeing the stock exchange to understand what it is. But now have you seen the stock exchange and seen all the things? So life becomes very easy and you can understand it without any problem. It takes, months together to understand, whether it is in the money, out of the money, at the money, if you have not visited the stock exchange screen. Okay.
This is an option that has a strike price equal to the current price of the underlying stock. At the money. This is an option that has a strike price equal to the current price of the underlying stock. The Tata Steel option with strike of rupees 1300 as at the money when the stock is trading at or near the strike price.
Okay, so 1300 will be close to money, near to the strike price. Okay. So, some examples here. So now we have actually gone to the stock exchange scene. So suppose if Tata Motors is trading at 250, so 240 will be in the money, call option. Okay. 250 will be at the money and 260 will be out of the money. Okay. Similarly, you look at a put option, it will be the reverse. If the market price of Tata Motors is 250, okay. So when I prepared the slide, it was stock price of Tata Motors 250, but now it is not. It is either, I think, much higher from this level. So strike prices of 240 will be out of the money and 260 will be in the money. Okay, fine. So option premium again will depend upon, in the money and out of the money. If you look at the last line, this is the premium. So premium will be the highest when it is in the money. Okay, fine. Okay, so now the most important part we have to do. So there will be a question in your exam also. Okay, fine. So listen it carefully. Option premium.
We have to, who pays the option premium? The call buyer or the call writer?
Is it the writer or the buyer? Buyer. Who collects the premium? Right. Okay. So, factors that determine the price of an option.
That means the premium. You know, when we go to the screen, we find the premium is already there. Okay, the writers basically they are the people who fix the premium. Okay, they are the people on the basis of market forces. The premium is decided. Okay, in the stock exchange. So, what are the factors that lead to in determining the option premium? So that's the most important thing. Okay, major and minor factors. Read.
There are 4 major and 2 minor factors that determine the price of an option. The major factors are price of the underlying,
The first factor is the price of the underlying. Okay, fine. Second,
volatility of the underlying, strike price of the option, time remaining until the option
so
expires.
these are the 4 major factors. Price of the underlying. If the price goes up, the premium will also go up for a particular strike price, isn't it? Have you followed? Should I put it on the board? हाँ?
Follow the underlying also go.
आप तो आगे समझ में नहीं. अगर आपने एक स्ट्राइक प्राइस लिया हुआ पकड़ा हुआ है और प्राइस ऑफ द अंडरलाइंग गोज, द प्रीमियम विल आल्सो गो अप फॉर दैट स्ट्राइक प्राइस. आज तो आज का एक पर्टिकुलर स्ट्राइक प्राइस का
Suppose, for example, you are just getting money.
as a writer. Okay, so price of the underlying has a factor. As the price goes up, the call premium will go up and put premium will fall. It will have a reverse trend there. अगर price बढ़ेगा तो put person wants as a bearish person, so the price is going up. So that means for the same strike price, the premium will also start falling. But in case of a call option, it will start going up. You समझ रहे? Next, volatility of the underlying. As I explained you, higher the volatility, higher the premium. The greater chance that it may go into your direction, and it doesn't give you the direction, but it can move here and there. So it gives the more chance to the buyer of the option, whether you're a call option or a put option, to make money. Okay, so that's why the option writer will demand more premium from you. More volatile means the more greater chance of the call buyer or the put buyer making money. Because the stock can go to the direction which you want. Suppose it happens like that. Okay. So after doing a careful technical analysis, he sees that the stock is volatile, it will move in direction, so he will trade in that direction trade. So the call writer or a put writer will demand more premium from him for taking that privilege. Okay. Then the strike price of the option. As we know, the strike price, if it's in the money, more premium, out of the money, less premium. Then the time remaining until the option expires. So if you choose March, premium will be less compared to the April. So अगर April का contract लेते हैं, has a 2 months. But March is also again, the option writer will keep the government investor and will charge more premium. So strike price for 2 call options for March expiry and April expiry will have a higher premium compared to the March. Is that okay? Is that sure? Is okay? Okay. The minor factors. The minor factors are the interest, risk-free interest rate. The interest rate, you can say. So that is one factor. Second is dividend rate of the underlying stock. So these 2 factors are very, very minor factors which play the role in fixing the option premium. And we'll discuss that when the slide comes. Okay. Price of the underlying. First, we'll start with the price of the underlying, which I have already explained. Read this.
The premium is affected by the price movement in the underlying instrument. The call options are right to buy the underlying at a fixed strike price. As the underlying price rises, so does its premium. As the underlying price falls, so does the cost of the option premium. For put options, the right to sell the underlying at a fixed strike price. As the underlying price rises, the premium falls. As the underlying price falls, the premium cost rises.
Is it okay? Just have a look again. Just read it yourself. And if you find anything which you have not followed, we already discussed the case where the price of underlying, in case of call option, for the same strike price, if the underlying keep rising, the premium will keep rising. But it will take a reverse direction in case of a put option. When you buy a put, you expect the price to go down, but if the prices are going up, so the premium will fall. Or if the prices are going down, then the premium will rise. Okay? इसमें क्या होगा? Price गिर रहे हैं, for the same strike price, you will find the option premium is rising. Fine. So you can do the same thing. If you have written a put, you have bought a put, you can write a put and make the money. Okay, but you can close the similar fashion there also. So this is basically the table chart which summarizes this. The call option, underlying price goes up, the premium cost also goes up. Underlying price falls, the premium cost also falls. Put option, underlying price rises, premium cost falls. Put option, underlying price falls and premium rises. Is that okay? Clear? Then time value of an option.
Generally, the longer the time remaining until an option's expiration, the higher its premium will be.
Okay, fine, it's very simple.
This is because the longer an option's lifetime, greater is the possibility that the underlying share price might move so as to make the option in the money.
Fine. So if you have more time, so the premium will be higher because the chances are that your option will move in the money.
All other factors affecting an option's price remaining the same, the time value portion of an option's premium will decrease or decay with the passage of time.
So if everything remains, the volatility remains the same, all other factors remain the same, with the passage of time, the premium is going to fall. Okay? Okay, so एक सेकंड ये क्या लिखा है इसको पढ़ते हैं चलो इसको छोड़ देते हैं अब ये पढ़ो so what happens if you look at basically the time to expiry if the time to expiry is higher the premium cost will be higher if the time to expiry is less the premium cost will be less the same similarly for put also okay fine इसको देखते हैं क्या लिखा है
This time decay increases rapidly in the last several weeks of an option's life. When an option expires in the money, it is generally worth only its intrinsic value.
yeah so it has two meaning as the time is reaching to the expiry the premium will decline much faster अगर 2 ही दिन रह गए और प्रीमियम जल्दी गिरेगा अगर 20 दिन रह गए तो द फॉल और ऑफ द प्रीमियम as the time is coming close to the expiry the rate of the premium which fall will be much higher the last few week of at the time of expiry जितना टाइम कम होता चला जाएगा प्रीमियम बहुत जल्दी से तेजी से भागेगा शुरू में it will move slow but as the time the expiry is nearing the premium will fall drastically on the date of expiry the time value will be zero so entire premium will be represent only the intrinsic value okay the difference between the strike price and basically the price the spot price prevailing on the expiry so that is the money which you have made actually okay in the money so this we have done okay volatility
Volatility is the tendency of the underlying securities market price to fluctuate either up or down. It reflects a price change magnitude. It does not imply a bias toward price movement in one direction or the other. This is a major factor in determining an option's premium.
so basically the volatility doesn't tell you which way the stock will go but it is quite volatile the chances are it can move in your favor or it can go against your favor okay fine so this is one of the major factor in determining the option price so we'll spend some time on it okay
The higher the volatility of the underlying stock, the higher the premium because there is a greater possibility that the option will move in the money.
is that okay
Generally, as the volatility of an underlying stock increases, the premiums of both calls and puts overlying that stock increase and vice versa.
yeah so volatility will have a positive impact on the premiums whether they're put premiums or the call premiums
Know your option volatility. Volatility measures the rate at which a security moves up and down. If a security is moving up and down quickly, volatility will be high. Conversely, if a security is moving up or down slowly, volatility will be low. Options volatility is largely pinned to the underlying stock.
okay because the volatility depends upon the stock itself the underlying stock fine if you're taking a call option on Tata Steel so the volatility of Tata Steel which is the underlying has a bearing on the volatility of the premium will decide on the underlying volatility not on the strike price okay fine
Higher volatility is equal to higher premium, lower volatility equal to lower.
simple so again here the same relationship call if volatility is high the premium will be high if the volatility is high premium will be high both for put and call options okay so now we come to a major part here please listen to it carefully volatility is a measure of fluctuation just read
Volatility is a measure of the fluctuation in a stock's or index price and often plays the most important role in option trading. Knowing the volatility can help you choose and implement an appropriate strategy.
so basically to implement what you should do should you write a call should you buy a call okay and there are so many other strategies we'll study so all depends upon this factor
Improve your timing in entering or exiting position.
So it depends, when you should enter, when you should exit. Okay. If you find the volatility is increasing, so when you should enter, when you should exit. So this will understand more in detail.
Identify overpriced and underpriced options.
So basically this is the most important. So you want to know whether the option is underpriced or overpriced. Okay. If you find it is overpriced, become a writer. If it is underpriced, go for a call option or a put option, depending on which way the stock you expect to go. If it is very underpriced, then the premium is very less, so you can bear the loss. So you can buy a call option or a put option. But if it is very high, you think you may lose that money. So instead of becoming a call buyer or a put buyer, you can write a call or write a put. You can pocket that premium. The chances of the call will not be exercised or put will be greater in that case. Okay, is that okay?
Volatility is a measure of the amount by which an asset price.
So historical volatility and implied volatility. Now implied volatility is what the option writer is building in his premium. Okay, because he has a right to ask you whatever premium he wants, but again depending on the market forces. अगर मार्केट ज्यादा चार्ज कर रही है तो वो भी चार्ज कर सकता है. तो उसने जो चार्ज करा है उसके अंदर वोलेटिलिटी प्रीमियम भी शामिल है आपके ऑप्शन प्रीमियम में. ओके, सो दैट प्रीमियम इज कॉल्ड द इम्प्लाइड वोलेटिलिटी प्रीमियम. If all other things remaining same, it is only the implied volatility which is making the option premium costlier. Okay, then we say the option premium is really higher. Okay, so you should become a writer rather than a buyer. Compare the historical versus the implied and see what should be the option premium theoretically and what it is. Okay, if you find it expensive, then go for writing. So let's understand that through a site. So this is interesting. So just you have your laptops, nahi? कोई बात. So we can just open the WhatsApp. I just shared some, in the morning link there. Let's see if we can get it. Yeah, derivative है ना हमारा. हाँ. So this one. हाँ, कल 6 बजे 6:45. Okay. Fine. So just go here. Fine. So this is the stock. Like by default it's coming Nifty. You can choose even an index. You can choose any stock like Reliance, or for example we can choose Tata, or say Reliance, for example. Reliance. The current price is 2,255. Okay, yesterday I bought it at 2,290 when the market is falling. But it fell down to 2,240, the minimum price. But I bought it at 3 o'clock. So I thought कि कितना गिर गया अब और नहीं गिरेगा. और उसके बाद अभी आज उठने के बाद भी वो भी 45 rupees lower है compared to the yesterday's price. Okay, fine. So exercise price. So you choose an exercise price. Suppose I choose a price of, say, for example, say 2,250 at the money. Suppose let's take at the money. I can choose any price. Transaction date. So today is basically 25th. I choose today's date. Okay. Expiration day, I choose 31st of March, which is the next month expiry. March 31st. Okay. 31st March is the expiry for the monthly expiry. Rate of interest is taken as 10%. Okay. So I told you there are 4 factors, 2 minor factors, rate and interest and dividend also. Now, the implied volatility. This is the implied volatility. We can even increase it, okay? You want. We can do it whatever we want. This is the historical volatility, which is just calculated by looking at the software. So historical volatility is 35.4, but it is currently, I can make it to even 0. I can make it like this. So let me just, look at this. So if it is, implied volatility is just close to about nothing, then the premium should be 26 rupees, call premium. Okay. Suppose I make it to, for example, almost equivalent to, say, the historical volatility. Say like this. So यहाँ historical और implied बराबर होगी. Fine. So let's see the premium. So the real premium should be 110. इतना premium होना चाहिए. But if I go to the screen and find that the premium is, like this, उसने 48% built up कर लिए. So premium will be this. So if I go and see the premium, what I saw in stock exchange is 144, and it should be around 110 or something, right? The same volatility. So the premium is high. So if I take a buy call, then I may lose money. The chances of losing money are much higher, right? Because the premium is already very high. Okay, just read this, Nikita. Value of the option premium and the price of the underlying change. Now, all these factors, okay?
This is a graphical representation of the possible option prices when the price of the underlying stock/contract is assuming other factors such as time, volatility, and interest rates remain same. This will help you judge the upside and downside of the option value when the price of the stock underlying changes. In the current example, all other factors remaining constant, the call would be valued at 171.16 in case the price went up to 2,300.75. And in case the price went down to 2,210, the fair value would be 120.
Basically, this is the underlying price of Reliance. Okay, and this is, if the price goes up, the call premiums are going to rise. Okay, so at 2,300, the thing, this call price will go to 171. Okay, fine. So value of option when the price of the underlying changes. So underlying price is changing and the premium is also going up. Okay, is that okay?
Yes.
Fine. Then we look at impact of time value of an option. So if you have more time, higher the premium. Just read it.
As a general rule, the option value falls as the option approaches its expiry. This graph explains how the value of the option would fall as the time moves towards expiry, assuming all other factors, that is underlying price, volatility, and interest rate remaining the same. In the current case, the value of the option would fall to 55.75 on the expiry date 31st March, assuming that the price of the stock/contract and the
IV is implied volatility.
remain the same.
So basically, as the option is approaching the expiry, you can see that it is falling. So first it's a gradual fall, and then the fall then goes very steep as it reaches to expiry. It almost becomes zero at the time on the date of expiry. So one more, then we'll have a break. Impact of time on the option, ये हो गया ना?
Impact of change in volatility on value of option. As a general rule, if the implied volatility, that is expected volatility, is greater than the option value, will be higher and vice versa. Option values will be higher if the implied volatility is greater and vice versa. Remember that the IVs are usually high ahead of any specific event or announcement and fall after the same, and hence option prices may not move exactly the same way as the stock contract does due to the change in the IV. In the current case, if the IV went up from the current levels of 48.1% to 53.1%, the value of the option would go up to 150. And in case the IV went down to 43%, the value of the option would go down to 121.
So basically, this is the present implied volatility. So if the volatility keeps changing, the premium also goes up. If the volatility goes to 50, the premium also rises. So the option value will be high if the implied volatility is greater and vice versa. You should remember that IVs are usually high ahead of any specific event or announcement. Because if suppose company is going to announce results, so you will find that there's certain volatility. So people may expect, very good result than what was expected, or they can expect other way around. So that time the volatility stock goes up because it's related to one of the milestones, the results are being announced, or maybe some amount actually going to be done, or some important post case in the company. All these can, affect the volatility of the stock, and which can, impact the implied volatility also, because the writer may feel that, such event can, make the stock move here and there, so he will try to increase the, option premium, okay, and charge you much higher. So this is okay. So you can just, at your home, You can just go to this site. I've given the link and then analyze yourself. Okay.